Welcome back to Season 6 of the Group Practice Accelerator podcast, brought to you by Polaris Healthcare Partners, where we leverage decades of healthcare and business experience to drive growth in successful group practices just like yours. If you're a healthcare entrepreneur and you're interested in building, scaling, or exiting your group practice, you've found not only the industry's leading resource for business education, but a team of trusted advisors dedicated to helping you achieve and exceed your goals. In short, the team at Polaris creates clarity, confidence, and results. I'm your host, Jamie Falasz, and the Group Practice Accelerator podcast is on the air. Well, hey everyone, thanks for joining me again this week. As founders, today's episode is really for you because today we're going to build on a couple of our recent episodes around transactions, selling all or maybe even part of your business. And we've covered some legal perspectives, things you need to consider and prepare for as a seller, even timing. When's a good time to sell? And you already know that that book isn't closed when you close on your transaction. But one thing we haven't focused on recently during the show is the who, meaning who you choose to sell to and why. And importantly, how to make that decision from a risk adverse perspective among other factors. Because at the end of the day, we understand that this decision has to not only be supported by the appropriate legal agreements, but it has to come with a healthy dose of trust. Because, like I said, the book's not closed and you're trusting the buyer with your business, your legacy, your people. So there's really a lot to consider. And we're looking at the quality of a buyer here today. And that's what this episode is really about. And today's conversation comes directly from an article that our founder and CEO just published where he advises on how to evaluate buyers, which you can find on LinkedIn, or you can go to our website. It's part of the news and stories tab under blogs. So you can check it out there and I'll link to it later in the show notes. But without further delay, please help me welcome Diwakar Sinha back to the show. Diwakar, great to have you here today.
Jamie, thanks for having me.
Yeah, that was a really good article. And as I'm seeing, the traffic from that, it just makes my mind go to, gosh, people might have more that they want you to elaborate on here today. So I kind of want to get right into it because I know there's a lot of concern when people are going to market, just a lot to consider and things that impact their transaction post closing. We all think about what happens up to the day of closing and, people have dollar signs in their eyes, which is natural. But we also know that choosing the wrong buyer and focusing solely on what the buyer's willing to pay me can really undo years of my hard work, right? So if we're going to talk about buyer quality, maybe we start with why that quality has to trump price and where you think we should jump off from there.
Yeah, sure. So I think in a couple articles ago, I talked about what caused pause, a few years ago in valuations with the capital markets and so forth, and just kind of update the audience. Since
Mhm.
the last time I was on a couple weeks ago, SOFR's continued to come down. Right. So I
Yeah.
think it's come down, I think 20 basis points. So it's meaningfully starting to improve and the markets continue to improve. And I think 2026 is really a good positive year. So I think the momentum towards transaction is going to continue to move forward, and valuations will be robust in this year. So I think as buyers are evaluating these sell side transactions, sellers are evaluating the buy side transactions. They need to think about, okay, they're going to be courted. Okay, who's the right partner for me? And a
Mhm.
lot of people were concerned about previously, okay, what's my rollover equity going to be looking like? And so when they're thinking about it, they need to think about it. There's a lot of pause about rollover equity previously. Okay, how do I make sure I don't get myself in the same position again as I
Right.
transact in 2026? And my rollover equity going into 2026, I might recap in 2028, 2030, 2035. Some firm funds might be exiting in 2 years. Some funds might be exiting 7 to 8 years, depending on their life cycle. Some
Mhm.
some funds, recapitalize in their own fund on a later cycle. So there's different processes, right? So I think it's the number one thing to kind of think about is how well capitalized are they, in their fund cycle. How much have they allocated towards this growth for this group? Let's say, for example, this group is 20 million in EBITDA. They've currently deployed 50 or 75 million, and they've allocated 100 million. Well, that's not a lot to continue to grow that business. So you really need to start thinking about the overall capital allocated to grow this business. And of course, they're going to leverage some debt on top of it. So you want to think about, okay, how much capital is allocated and how much debt are they levered on top of it. So because
Hmm.
again, that's going to impact your return on equity on it. And again, in our previous podcast, Jamie, we have talked about JV versus holdco equity, and again, that also has an impact on recycled cash and your return on equity. And again, I'm not sure if we're going to have time on to talk about how that plays on return on equity. Generally, I'm more of a fan of holdco equity. There's a lot of economics factor on why that may give you a better return on equity. Again, there's a lot of legal provisions that you need to kind of think about how holdco equity may play a better versus JV, and sometimes JV does play a better position depending on how it's legally structured
Hmm.
towards holdco. So again, I don't want to speak and give it a broad stroke on what might be a better position. And then, in the article, also talk about how underwriting is done, right? And I think
Yeah.
in the past, in the talked about some of these deals were underwritten in between 2021 and 2023 with not the right assumptions, so how these deals are being underwritten in 2026, with the platform is going to be important,
Hmm.
understanding how they're underwriting these deals are important, not just your deal, how they've underwritten other deals is going to be important because, you might perform really well, you may do a really good job, but if they've underwritten other deals not to performance, that's going to impact your equity indirectly. So I think, you're beholden not just to your performance, to the performance of your peers. So I think these are things to kind of think about. So there's a lot of factors that go into it.
Definitely, and a buyer can come to you with a really attractive pitch deck, but you've got to do the homework behind that. And, of course, that's where we can help. And, we know that every transaction comes with risk. It just does. And our aim is to minimize that. And you touched on some of these risks in your article, and you just kind of hit the highlights here a minute ago with the 3 risks that founders need to take a look at really closely: capitalization, leverage, and underwriting. Can you go into a little further on capitalization? And we wanna make sure that our buyer can support what they're promising. Can you go into that a little bit further?
Yeah. So I think one of the resources we bring is the ability to go behind the scenes and understand the backing of the company. So it's important to understand that the DSO or the MSO that's there and how they're performing, right? Overall, as far as growth trajectory, and then the sponsor that backs them and how they've historically performed. That's
Mhm,
important to understand in the market. So I think that's number one to kind of think through and validate that. Not just, let's say, for example, they're this one platform that might be partnering up with our client, but historically how they've done across different platforms. Hopefully, it's not their first healthcare platform. It's they've
I was
done
just gonna say that.
different healthcare platforms.
Yeah.
And so that's one. Two, their capital position is strong. Like they have they're good assets in their management. And again, it could be a family office. Family offices are more and more entering the healthcare space, so they have a good assets in their management. I just talked about, if they have deployed 50, 75 million, if they have $100 million allocated, that probably is not a good capital stack. So,
Mm,
we want to start looking forward as far as the trajectory of the business over the 3 to 5 year cycle and say, okay, how much capital do they have available to grow and do further de novos or acquisitions? Because again, they're going to have to lever up equity and debt to continue to grow. And in most cases, you want to be 2 to max 3x, really closer to 2x, maybe 3x lever, and above 3x lever, you start to be over levered on a business. And I think you start going back to some of the companies that are not performing well today or historically in the past. They've been levered 4 or 5x, and then that tends to put a lot of compression in the market. And we experienced that when SOFR increased, from like sub 1%, really is closer to 0.05% in the past, to almost 5% in 23, 24. So I think just to kind of, give some reprieve, you don't want to be over levered. So, debt position matters. And then their lender relationship. So, what does a lender position look like? Is that lender that they partnered up with heavily invested in the vertical they're in? or they have de-risked themselves. Like, they're a little bit in dental, a little bit in dermatology, a little bit in plastic surgery, a little bit in the orthopedic space. So they've kind of de-risked themselves a little bit, or they like heavily into dental, where they may not continue to invest a little more into dental because they have a lot of their capital in dental, right? So these are things to kind of think about.
Yeah, and I want to get back to being over levered in a second here, but on capitalization, if let's say a buyer's undercapitalized, like to me, that directly impacts patient care at the end of the day. And I built this business around my patients. I have a great team. But if they don't have capital to further invest in technology, keep up recruitment, maintain our leadership team, and things like that, like, to me, that impacts patient care at the end of the day. And doesn't that really end up impacting your enterprise value?
Yeah, I mean, I think if they don't have a lot of capital, then they kind of run it as a lean and from their lens, it's going to be a lean and mean machine. I guess that's the word that's used in the industry. And yes, I
Yeah,
mean, I'm a fan of a lean and mean. Obviously,
sure.
operationally efficiency, but I think there's a probably uh, other side would be like, okay, do they have the capital to even invest in the business, to kind of grow the business as far as investing in the right technology? I mean, there's a lot of investments in AI to help make operational efficiency in the business, to scale the business, right? To do
Mhm.
further de novos and capex things. They may need 10 3D machines in the business, and they may not be able to invest in the 10 3D machines plus additional AI to diagnose better, to help augment the care that the providers need to do to continue to grow. I mean, robotics and all these things that are augmenting care in the space, right? So I think those are the things that you start to say, okay, if they don't have the capital, then they can't grow. I mean, I was talking to somebody that was a recruiter in the space, and then they had uh, been engaged by a sponsor to bring on an executive, and then they're running so lean and mean that in their process, that halfway through the recruiting process they put a pause in the executive search. Again, that's
Yeah.
not really where you want to be in that process. These are the things that people experience if the capital stack is thin, or the business is over levered.
Yeah, there's a fine line between lean and mean and efficient. I mean, we're all about efficiency. However, when it starts to impact at the end of the day your patient care or how patients are managed, that can really have a detrimental effect. I want to jump back to being over leveraged for a second here. Can you tell our listeners again, because this is really important, how if a buyer is over levered, that it can impact their rollover equity? I want them to hear this again. I know you touched on it before, but I think this is really important.
Yeah, so just like I want people to understand, like that when we take their business to market, right? So when we take their business to market, the debt sits in a preferred position, right? So let's say
Mhm.
a business is valued at $10 million, and they have $2 million in debt. The debt has to be paid off, so the net equity is $8 million, right?
Right.
Indifferent of the rollover equity and all those components that sit out there. That's no different in most cases. I don't want to say in all cases, than a sponsor back deal or DSO deal, right? So how much they're levered matters in a DSO or MSO. So I think it's important for people to think about and realize how much leverage there is. So if the business is over levered and the DSO or MSO transacts in 3 to 5 years, that's going to impact their rollover equity and how much cash at closing and the rollover equity happens. So, and then also how they're buying and how they're growing and how they're making operational efficiencies to grow the business. If there's aggregating in the market, and that DSO or MSO is not able to make same store improvement because that's not their process, that's not their quote unquote secret sauce, then, I mean, they're not going to create accretive improvement for shareholders, right? So I think
Mhm.
that's important to understand, that debt can't is going to impact their rollover equity in the position. So that's why, again, not to kind of go into holdco equity and how recycled cash impacts shareholder equity, but that has a little bit of position into it. It also impacts in downturns in business. If they're over levered, again, that's going to impact a potential receivership. Banks
Mm.
can kind of come in and say, okay, you have defaulted on your debt covenants, and now we're going to start running the business. So I think,
Yeah.
so those are things that come into play if the business is over levered. And again, no different than if you're a small business owner. Some of these same things happen for a big DSO MSO. There's warrants in place, from a bigger lender that, that some performances have to be in place and cash flow covenants have to be met. So I think these are things to be kind of thought through from a bigger DSO, MSO place in there. So I think these are things that need to be thought through when people are transacting their life's work.
Yeah, absolutely. And thank you for going through that again. It was worth repeating. Now, going to that third risk, we talked about underwriting discipline. You mentioned here in your article, and the word blindsided is something that you chose to use, and I like that because I do feel like there's a lot of focus again on the front side of the transaction. This is one of those things where we get to the back end post closing and docs can be like, oh gosh, what did I really agree to? And my mind goes to maybe an unrealistic earnout, but I know there are some other ways that docs can get blindsided. Can you run through those for our listeners as well?
Yeah. So, so I think when we work through the buy side, um, we can fairly quickly tell who's collaborative and who's not, right? And so I think collaboration starts in how we initially open up our data room. And in our data room process, we can tell from a buy side, hey, this buy side is going to be really good for our client. And so I call it a dating period for us. That dating
Mhm.
period really starts for us early. And we can tell, if we have 20, 30 people, 50 people on the buy side in the data room, that this is going to be more than likely, hopefully, if they get into the LOI phase, that they're going to be a good potential partner for our client. And when I say that underwriting process starts really then, for us because they're going to start asking us questions about our client's business ask us, hey, how's this working? How's this working? How's this? So that underwriting questions really is like meaningful for us then. And then when they issue the letter of intent, that becomes pretty interesting for us because how they issue valuation structures and how they issue earnout structures are important. Because I think the buy side is, trying to, lack a better word, put valuations to get the best value to win the deal, right?
Mhm.
On a earn and earn out.
Yeah.
And at the same time, you know, I think I said in one of our previous podcasts, we don't want to put an earnout out there that our clients cannot achieve. Okay.
Right. Yeah.
Uh, and, we pride ourselves to make sure that we hit that balance that is achievable for our client and for the buy side, because we want the buy side and our client to be harmonious post transaction. So, and we look at the buy side and say, okay, if they're putting targets out there for our client that are unreasonable then it's not going to be harmonious for our client. Then it makes us uh, kind of question, like, okay, have they done this for other people where there's not a harmonious position to be achieved, right? And so, how, also employment agreements, how the employment agreements have
Mm.
been structured.
Yeah.
Those are the things we start to question across the spectrum. And what are the risks? And I said earlier on the podcast, our client can perform, our client can do a lot of good things, but if the platform has underwritten other deals in a perspective that can impact our client, then even then those things can be challenging. Again, we can't prevent everything across the platform, but
Right.
I think we can put our clients in the best position to have the best likelihood of success. And of course, I'm not saying the platform out there is making bad decisions out there, but I just think we have to look at those things and say, okay, out of all the platforms out there, is this platform overall structured the deals the best and, has the best likelihood of success?
Yeah, and that's where you lean on people with experience that have seen most, if not everything, come across their desk before, and they know how to advise on it based on what you want as a seller. Now, I kind of want to switch gears just a little bit, and if I'm evaluating a buyer, say I'm ready to sell and I'm ready to go. If I'm a founder and I'm sitting with my advisor and I'm looking at a pitch deck, what should I be looking for? Like, what are the let's say your top 4, top 5 elements that should really jump out to me, or what are the first things that should come to mind as I'm going through this?
Yeah, I mean, I think is the uniqueness, right? What is the uniqueness in that platform?
Mhm.
That is being marketed. The location demographics is important. How
Yeah.
that's being marketed, the organizational infrastructure. Again, at 3 locations, at 7 locations, at 20 locations. The layout's gonna be different, right? Just because the infrastructure is gonna be different at those locations. How we're marketing it to a strategic at different demographics gonna be different. At 3 locations, we might be a tuck-in to an already established demographic. At 20 locations, we might be going to a new geography for a newer for a platform that's looking for something for 20 locations in the market. So we may need a good infrastructure support team. So we need to kind of highlight those. We need to focus on clinical team, clinical infrastructure that's already there, that's going to be there. The partnership structure of doctors and executive teams that may be ongoing with the transaction is important to highlight. The growth trajectory of the business is important to highlight. I mean, I think these are all things we need to focus on. The retention of team members is important to highlight, right? If there's patient growth is important to highlight. And again, you're not going to have patient growth every year. You're not going to have revenue growth every year. You're not going to
Yeah.
have EBITDA growth every year. And I think a lot of people just try to show the positive. I think it's, let's say, for example, in 2024, you had a decline. I think it's important to address, okay, in November 2024, October 2024, we had a dip. How did we recover from that dip? It's also important to highlight. No business is perfect. I think the businesses that do really well when they go to market are able to address how they recover. Leadership is not about the successes; it's how we recover from our failures. And I think the buyers want to see the how businesses overcome their adversity because they
Exactly.
want to partner up with businesses that not only are good in their good times, but can be a leader in the bad times and help partner groups in that process. So I think those are the things we want to put in the deck and work with our clients on the deck.
Yeah, I wholeheartedly agree with you. That resiliency, I think, can really count for a lot. In fact, Justin Marty and I were talking about this on a podcast a couple of weeks ago. From a legal perspective, in transactional work, like get your skeletons out of the closet. Let's talk about them now. Let's explain them up front because buyers are going to dig them up. I mean, if you had a dip in the business or if you had some event that you feel needs explaining, let's explain it. It doesn't mean that your buyer's gonna run away. It just means that, let's put all the cards on the table. And like you said, it's how we react to that, how we solved for it, that I think makes a bigger difference at the end of the day. So thank you for going through that, Diwakar. Closing thoughts?
Yeah, and I think the whole purpose of my article was to educate people that I think the market is good. The momentum is good. And
Mhm.
understanding the buy side is important because if you understand the buy side, I think you can move forward with strength and responsibility. And there's a lot of good buyers in the space. They have good balance sheets, they're making good decisions. And I think, as I said in our previous podcast, that a lot of people came out of 23, 24 making good operational efficiencies into 2025 and 2026. So I think people that are buying in 2026 made a lot of good decisions, right? So they have,
Yeah.
good leverage positions. When I mean good leverage positions, like low debt positions, they have good cash available to buy the businesses. They've had good growth trajectories. So a lot of the things that I have put on in there, as far as thinking about risk positions, a lot of them are in a good position. That being said, there's still a few companies out there that are trying to acquire to get themselves out of a hole, right? So I think it's important to
Right.
understand which those companies are, and deal structures matter on JV versus holdco. We really I could not emphasize enough that we get calls from people out there that have transacted in JV structures that are not the best, and they're trying to figure out why those deals are not working out for them. So I think both not to put one versus the other. I think people need to kind of really be cautious of how they're transacting in the market. But I think the market 2026 is going to be good.
Well, I think our next episode needs to examine that Holdco versus JV. So maybe we can cover that on another day and deliver that for our listeners. Diwakar, always good to have you on the show. And to our audience, we love the questions you send us, so keep them coming. If you'd like to learn about any of our Polaris expert advisory services, or maybe there's a topic we haven't covered that you'd like to hear about, you can send us an email to info@polarishealthcarepartners.com or you can reach us by visiting our website at polarishealthcarepartners.com. Thanks so much for being a loyal listener and subscriber. If you enjoyed today's episode, please share it with a colleague and be sure to leave us a rating on any of your favorite podcast platforms. We'll see you on the next episode of the Group Practice Accelerator podcast.